Have you ever looked at a chart and just felt like the big institutions, the smart money, know something you don't? Well, today we're going to pull back that curtain. We're going to learn how to track their footprints by tapping into what is really the market's hidden engine.
Hey everyone, welcome to AI Explains ICT. In this video, we are jumping straight into the deep end with the first episode of ICT's fourth month of core content. We're going to focus on how professional money managers really operate, and more importantly, how you can learn to see what they're doing.
Okay, so this is the million-dollar question, isn't it? You spot what looks like a perfect setup, right at a key level you've marked out. But how can you be sure? How do you really know that the big players, the institutions, are on the same side of the trade as you? That's the puzzle we're solving today. And the answer, and this comes straight from ICT, lies in understanding the one thing that truly drives the entire currency market, and that's interest rates. If you can get a handle on how these are shifting, you get a direct window into what the big players are doing behind the scenes.
All right, so first things first, we need to understand what this smart money activity even looks like on a chart. It really boils down to two key patterns. One is called distribution, that's just a fancy word for institutional selling, and the other is accumulation, which is institutional buying. Let's kick things off with bearish distribution. So imagine the US dollar index is just ripping higher, right? It's making new highs, and to the average person, it looks incredibly strong. But what's happening under the surface is that smart money is quietly selling, and selling heavily. We can spot this because other markets that are usually tied to the dollar's hip, well, they fail to make those same new highs. This disconnect, this divergence, is a massive red flag that a top might be forming.
And this visual here shows it perfectly. That red line, think of that as your benchmark, maybe the dollar pushing for the sky. But that green line, that's the real story. That's the institutions distributing or selling into that rally. Their selling pressure is so heavy that it creates these lower highs in the correlated assets because they just don't believe the move is real. And of course, the exact opposite is true for bullish accumulation. In this case, your benchmark asset is making lower lows. Everybody thinks the market is weak, it's going to keep falling, but behind the scenes, smart money is quietly buying up everything they can. They're accumulating. And this heavy buying actually prevents those correlated assets from falling as far, so they start making higher lows. This chart really drives home that idea of underlying strength. You see the benchmark dropping, but the institutional buying, that green line, is so powerful, it's like it puts a safety net under the price of those related assets. They literally can't make a new low because the demand from the big players is just too high. This is the fingerprint of accumulation. So this all sounds great, but how do we actually spot these patterns in the real world of currency markets? We do it with a really powerful tool that ICT calls the interest rate triad. You can think of it as our special lens for peering into the world of smart money. Now, this triad is made up of three specific futures markets that, together, give us a full spectrum view of what's happening with interest rates. You have the 30-year T-bond for the long-term perspective, the 10-year T-note for the intermediate, and the 5-year T-note for the short-term view. By just comparing how they're all moving, we can see institutional order flow in almost real time. Okay, listen up, because this next part is absolutely critical to understanding any of this. The charts we're looking at show bond prices, and bond prices have an inverse relationship with actual interest rates, their yields. So let me say that again. If you see the bond price chart going down, it means interest rates are actually going up, and higher interest rates are bullish for the dollar. You have to burn that into your brain. The main signal we're actually hunting for within this triad is something called a failure swing. This is the golden ticket. It's what happens when, for example, two of the bond markets make a new low, but the third one just doesn't. It refuses to follow. That disagreement, that divergence is our clue. It's a signal that smart money is making a big move. Here's a super simple visual of what I mean. Just look at the top and bottom patterns. See how they're both making lower lows? They're moving in sync. But look at the one in the middle, the one in blue. It fails to make a lower low. Instead, it makes a higher low. That's it. That is the failure swing. That's the signal that there's some hidden strength coming into the market. Okay, theory is great, but let's see how this actually works in a real-world scenario. We're going to break down a high-probability trade on the US dollar index that was confirmed using this exact methodology. So context is everything, right? Here we are between December 5th and 8th, and the dollar index is selling off pretty hard. It makes a very clear lower low on the chart, and it's heading right down towards a major support level that we'd have marked around 99.50. Now, on the surface, this looks completely bare.
But while the dollar was making that new low, the interest rate triad was telling a completely different story. Remember our inverse rule? When bond prices go up, rates go down. So here, the 5-year bond price on the right made a higher high, which means short-term rates weren't as strong as they looked. At the same time, the 30-year bond price on the left made a lower high, which meant its underlying rates were stronger. This disagreement is exactly the divergence we're looking for. So let's just put all the pieces together. The dollar index made a lower low, but the bond markets were all over the place. We had a failure swing in the 30-year bond price, the 10-year was basically flat, and the 5-year price was pushing higher. This complete lack of agreement was a massive signal that the true sentiment on interest rates was shifting under the hood. And here it is, the payoff. That massive divergence in the triad was our confirmation. Just as the dollar tapped into that key institutional level, that old bullish order block, the failure swing from the bonds told us that smart money was stepping in to buy. It validated the level and basically gave us the green light for a long trade. So this is obviously a really powerful tool, but how can you actually start applying it to your own analysis? Let's break everything we've talked about down into a simple framework you can start using today. It's really just a 4-step process. Step 1, do your homework on the dollar index chart and identify a key institutional level. An order block, a liquidity pool, you know the drill. Step 2, as price starts getting close to that level, you open up your 3 bond charts. This is your observation window. Step 3, you go on the hunt for a divergence. You're looking for that telltale failure swing, where one of the markets just refuses to play along with the others. And finally, step 4, you use that divergence as your confirmation. It's the market's way of telling you that institutions are likely defending your level. And this right here is probably the biggest takeaway from the whole video. This tool isn't just about finding great trades, it's also about knowing when to stay on the sidelines. If you don't see that clear divergence, if that smart money fingerprint isn't there, ICT's advice is simple. Just pass on the trade. This is how you filter for only the highest probability setups. If this breakdown helped you see the market in a new light, do us a quick favor and hit that like button. It really helps us out. And of course, make sure you're subscribed so you don't miss our next deep dive into ICT's concepts. We know this can be a pretty dense topic, so if anything was unclear or you have more questions, just drop them in the comment section below. We have a real human who reads and responds to every single one. So the next time you see a setup that looks perfect, just take a moment and ask yourself, what are the interest rates telling me? Is the smart money on my side? Until next time, good luck out there and safe trading.